Gold and silver, last time this happened, we were looking at the great financial crisis, 2008, 2009. Gold was sold down from $1,000 down to about $680. So it then went on after that to go up to $1,920, which was a significant move once the immediate crisis had passed. We could have the same thing today, but I think it's less likely because central banks are in there taking opportunity. Any stock that comes out, they will buy.
Gold's been under pressure lately. It's consolidating at lower levels because gold got caught up in all the hype with the liquidity surge. So you look at gold and platinum and silver pulling back. Listen, gold is a good hedge against inflation.
In this insightful market breakdown, Alasdair Macleod and Michael Pento explain why gold and silver may be repeating a historic pattern, but with a potentially explosive twist. In the 2008-2009 financial crisis, gold fell sharply from $1,000 to around $680 before launching into a powerful rally that carried it to $1,920. A similar setup could be unfolding today as precious metals pull back under liquidity-driven market volatility. However, the experts argue that conditions are different this time. With central banks aggressively buying physical metal, any supply that enters the market is quickly absorbed. This ongoing accumulation suggests that downside pressure may be limited, and that today's weakness is more of a consolidation phase than a true trend reversal. Gold, silver, and platinum have all retreated after getting swept up in the liquidity surge, but the long-term case remains intact. Gold continues to serve as a proven hedge against inflation and financial instability, and the current pullback may ultimately set the stage for the next major advance. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
China is definitely making a move to make gold exchangeable for yuan by opening vaults outside China. SGE vaults are being opened in Hong Kong and also in Saudi Arabia. I can see that central bank demand for gold is probably going to accelerate. And the other side of it is that following the debacle earlier this year, when the Bank of England had a rush on its vaulted stocks, I think the central banks who saw their leased gold walking out of the door will think, I don't think we really want to do this in future. So I think you'll find that gold leases, which are essential for the liquidity of the forward market in London, I think the availability of those leases is going to diminish. I suspect it's already diminishing. And I think that the bullion banks are already aware of this, which is why they're quite happy to talk the price of gold up now, just as the major banks are. You get Morgan Stanley and so on now openly talking about higher gold prices and talking about, you should have 20% in gold, I think in the case of Morgan Stanley. Things have changed hugely, but it's just that, when the equity bubble pops, there's going to be a lot of widespread fallout in all sorts of different things which are not directly related. The credit machine is going to get cranked up again, another notch. But whether it's enough to save the equity market, we will see. We don't know yet. We always know these things in hindsight. But I think the general point is that holding stocks is getting a very, very dangerous game. And I've been saying for some time on your program, I would get out of credit and get into real money, which is gold. And interestingly, once this market turns, once the bubble gets popped and stocks really start sliding, virtually everything will go with it. So if you've got mining shares, you'll probably find they get quite a lot cheaper in the process. Nothing to do with gold or silver, but just to do with the general distress in the market. As I said just a moment ago, the Bank of China is now extending facilities outside China whereby yuan can be exchanged for gold. That's the whole point about the new SGE vaults, which are being opened outside China. I mean, they are exclusively for the exchange of gold for yuan and vice versa. So that, I think, is a very clear signal that in the future, trade settlement on a national basis, if you like, what it's called international, between nations, will be on a yuan which is tied to gold. And it looks to me as if it's going to be, if you like, a modified version of Bretton Woods, where Chinese nationals, or indeed nationals in a BRIC nation, can't sort of go along to a bank and say, I want to change these yuan for gold or whatever at the exchange rate. I think it will be just available at the international level between nations. That's the whole thing. It'll be for trade settlement. I mean, that is absolutely clear. If you can't see it, then, you wake up, for goodness sake. It's all there in front of us. But what it does mean is that all the members of BRICS, who on the one hand are terrified of, having their dollar loans called in by the Americans or regime change forced upon them. I mean, this has been the history, if you like, of American imperialism. They're really quite careful in what they're doing, walking a bit of a tightrope on this one. But they can see which way this is going, and it does encourage them, I think, to get trade settlement arrangements in place. Hence signing up for the Chinese exchange trade settlement system.
Listen, this is just a chart of the inverse of the purchasing power of the dollar. So gold, the best thing about gold is its value never changes. It's a perfect parking place of your wealth. It's a perfect store of value. So what happens in these recessions and these bear markets, 2007 or 2020, what happens is, the Fed comes in and lowers nominal and real interest rate. And the perfect inverse of nominal and real interest rates is the precious metal. So as nominal rates fall, the competition for gold falls, and as real interest rate falls, that means you have to buy precious metals just to offset your inflation. So I don't anticipate anything different next time. I think we're going to go back into ZIRP. We're going to go back into QE, and in a big way, not just on a marginal degree. The Fed's balance sheet is going to go towards double digits, like I said, in a few years, and the perfect hedge against that is gold.
In this powerful discussion, analysts break down the major shifts unfolding in the global monetary system and why gold is positioned to benefit more than ever before. One of the most significant developments is China's aggressive move to make the yuan directly exchangeable for gold by opening Shanghai gold exchange vaults in Hong Kong and Saudi Arabia. This expansion signals a future where international trade settlement may increasingly rely on a gold-linked yuan, a dramatic shift away from the US dollar's dominance. Central banks appear to be accelerating their accumulation of physical gold, especially after recent incidents where leased bullion unexpectedly exited Western vaults. As leasing declines, liquidity in the London forward market is tightening, altering the behavior of bullion banks and large institutions, many of which are now openly recommending substantial gold allocations. With equity markets deeply inflated and vulnerable to a major downturn, the risks of holding traditional stocks have never been higher. A broad market unwind would pull many assets lower, including mining shares, but it would also force central banks back into zero interest rates and aggressive quantitative easing. In that environment, gold stands out as the ultimate hedge against currency debasement and financial instability. Let's get into the interview.
If the yield on the yen goes higher and the yield on the benchmark treasuries goes lower, then that spread contracts and the incentive to do that yen carry trade is obliterated. And that's a source of major liquidity. I don't know for sure. Listen, there's too many moving parts around the whole global system because there's stimulus in China, there's stimulus all over the world. All you have to know is that credit spreads is starting to expand and financial conditions have stopped easing. And that's all you need to know. That tells you liquidity is a problem. Maybe it's the reverse repo facility. All that excess liquidity, those excess reserves are now gone. So that easy money to buy bonds is done. Maybe that's part of it. I don't know. And I don't care. I really don't really care. All I need to know is that the market has the incipient signs of a liquidity crisis, and I am taking steps to reduce risk in the portfolio, period. Now, if you don't want to do that, if you just want to buy and hold your 60-40 portfolio because stocks never go down, and if they do, the Fed and the Treasury is going to bail you out, be my guest.
Yeah.
That's not the philosophy. It never will be the philosophy here. Everybody, Danny, everybody's trapped in these 7 or 8 stocks. Just because the S&P is market cap weighted, everybody owns this AI trade. In fact, AI is responsible for like 70 or 80% of GDP growth. Is responsible for most of the gain in the S&P 500. All the earnings, or that's where all the earnings are. That's where all the borrowings are. So everything depends on this AI trade. And if it is a bubble, and I think it is, and we have a credit crisis or turn down in the economy, and the cash flow to buy these hyperscalers and to finance all these chips, if that goes away, you'll see a crash in the AI sector, and that means the economy is going to be wiped out.
In this urgent market breakdown, analysts warn that the global financial system is flashing unmistakable signs of tightening liquidity. As bond yields shift and credit spreads widen, the once powerful incentives behind major liquidity engines, like the yen carry trade, are rapidly fading. When that spread contracts, a critical source of leverage disappears, exposing underlying fragilities across global markets. While countries around the world continue deploying stimulus, the deeper signals tell a different story. Financial conditions have stopped easing, excess liquidity in the U.S. reverse repo facility has evaporated, and the market now shows early symptoms of a developing liquidity crunch. For seasoned risk managers, these are not theoretical risks. They are actionable warnings. Reducing exposure and preparing for volatility becomes essential. Meanwhile, the concentration of market gains into a handful of AI-driven mega-cap stocks has created a dangerously fragile structure. With AI-related earnings and borrowing propping up much of the S&P 500, any disruption, whether from declining credit availability or an economic slowdown, could spark a sudden collapse in the sector. And if the AI bubble bursts, the broader economy could follow. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.